income mass market, which are not the middle class. And the middle class in Africa, again, is not like middle class in Europe. There are maybe people like, maybe some of the people listening here, you are earning like $3,000 or $2,000. So you're working in a bank and you live in Lekki or you live in Yaba or Deraba. You are maybe middle class, but the majority of the population in Africa are not even the people that can't earn money, like less than $2 a day, poor, that a lot of NGOs fixate on. But the $2 to $7 a day category of people, they are your drivers, they are the cleaners, they are the people that you see in Oshodi that are selling stuff on the roadside. They are earning money and they are spending money on something. But a lot of the value chain they are spending that money on is broken. It's expensive, or it's not, or it's not accessible to them. So education, for example, a lot of people in Lagos send their children to private school. But the private school could be one school in the backside of someone's house in a gutter somewhere. But these people want to spend money on private school for their children because they value education. But they're spending that money on an inefficient school. Or even clinics. There are lots of private clinics in Lagos that people spend money on, but the service is bad. The healthcare is really bad. So the idea behind Novastar is that, can we support entrepreneurs that are building business for that market and making it efficient, or making it accessible, or make it affordable for the low-income mass market? And that's the thesis of Novastar. It's very simple as that. And A is the biggest market in Africa, that if you are creating solution for that market, but also is the most impactful. So the founders of Novastar started about 5 or 6 years ago now, and they raised the first fund. And the first fund is $80 million. And the primary focus was that market, but also geographically focused in East Africa. And we invested in 15 businesses, and all of them in East Africa, most of them in Kenya, one in Uganda, and another one in Ethiopia. All the rest are primarily in Kenya. And that was to test the thesis that, can we find businesses that are addressing the largest market in Africa, create impact, but also huge financial returns using innovative, scalable business model. And we're still proving the thesis, but we've gone farther than 5 years ago. And then 2018, 2019, we decided to raise another second fund, which we just recently closed everything to about $108 million. And again, the same thesis, but now more geographically diverse into West Africa. And that's where I came in. I joined Novastar just after the first close of the second fund, and I was recruited to join to help build out the West Africa part of the firm, along with another colleague of mine who he spent a lot of time he's a Kenyan, but he spent a lot of time in Nigeria, was part of the founding team at Jumia. His name is Brian, and he's based in Lagos, and we're working together to build out our portfolio in West Africa. So that was the thesis about Novastar and how it operates. And so far, just to answer the top part of your question, in the second fund, because that's the only one that is focused on East and West Africa, we've invested in 3 businesses in the second fund, and 2 of them originate from West Africa. One is M-Pharma, which is solving problem in the pharmaceutical value chain, providing good drugs and inventory management for pharmacists and chemists in Nigeria and across Africa as well. So we participated in their Series B and the last round as well. We led it. And then the other one, which a lot of us here will know, is Max Okada in Lagos. Started from Lagos by 2 guys, Chinedu and Tayo. And they're based out of Lagos and now operating in Akure, operating in Ibadan and Kano. So those are the 2 businesses that we've invested in West Africa in the second fund. We also invested in one other company based out of, actually focusing in East Africa for now, but based out of England, based out of Wales. And they're building off-grid fridge that can work without electricity for many days, just using the unique property of water. So that's a long-winded bit about myself and Novastar.
Thank you so much for that. And it's very clear from what you said and what the the companies you have listed that your thesis is impact. It's as much impact as you can have on the mass market. It's interesting that you mentioned M-Pharma, because my next question was going to be on, given the crisis and where we are, how have you been able to support your companies? What are the things you've been able to provide for them, and how can we learn from some of the solutions that they have used to weather this crisis?
Yeah, so that's a good question. Like most people, when this crisis was slow and fast, right? Everybody was seeing it in the horizon, and it was just like one of those things that you're seeing, and then suddenly it's just eats you. And it's like that for a lot of our companies as well. It was a distant news in December, January, February, and then March. Everybody was caught up in the tsunami of coronavirus. And then we then sat down as a fund to look at, okay, what is the crisis? What is the impact of that for our business, for portfolio company? What can we do, and how can we help in it mostly? And the idea basically is we have to categorize our businesses into three phases, maybe few phases. One is the ones that they have to be defended, the ones that maybe they are struggling before now. Like if you see, we invest in a lot of businesses, but some struggling even before the crisis, and we're looking at maybe this might survive, or maybe this might not. And so we don't bother too much about that, because whether with the crisis or not, there's nothing we could do. But the other ones that they are doing well before the crisis, but the crisis is eating them bad, and we're thinking fundamentally these businesses are okay, they're good, but they've just lost maybe 90% of their supply chain, or lost 90% of their customer base, or significantly affected in their finance ability to raise finance because of COVID. So we have to take a view and say, if we remove COVID from this business is okay, and COVID we think is a temporary problem. It could be over time. It will go. Maybe we don't know when, but it will go. Can we help this business during this time to weather the storm? And because we know that the fundamental of the business is okay. So that's second category. The third categories are the ones that we know, we think that this crisis actually creates opportunity for them. Actually, it's just, this is a perfect storm. They need to do more. We need to get them more money or help them to innovate and think and pivot, because this is a perfect storm. So a good example is what you talk about, M-Pharma. And some other business in our portfolio that are primarily doing maybe healthcare. So one of our businesses called Penda, they do clinics, they do micro clinics in low-income areas. And so we looked at that and said, okay, what can we do? And it all boils down to, at the end of the day, we need to support them both with systems and processes, but with money. And the challenge, so we have interesting challenge. The first challenge is our first fund, where most of our portfolio companies are, we fully constructed our portfolio. And what I mean by that is that we're not investing in new money in that. We're just following on. And we're at the tail end of that fund, where we only have very little money left to put into some of the businesses. So there's little we could do from that fund. But then we are on the other side, which is an interesting place. We are at the second fund, which is just new. We just closed it. We only invested in 3 businesses. So we have tons of cash to invest in new opportunities. However, we cannot. We're not investing from the first fund into the second fund portfolio company. So what we then do is to engage with some of our LPs to say, well, how can we support our businesses? And we'll be looking into different interesting solutions around that. Venture debt, catalyzing rounds, and doing a lot of support for especially businesses that we know fundamentally they are good, but they're just really going through a lot of challenge now with COVID. And we're trying to make sure that they have enough capital to weather the storm. But beyond the capital, we also we've hosted like three webinars now with our portfolio company, talking about legals, talking about how staff, talking about how you do redundancy. Some of them have to make people redundant. How do you do that legally? How do you do that? How do you navigate through engaging with your staff and with your colleagues and all of those things? We talk about cash flow, and then we also engage. We engage McKinsey through one of our LPs as well to do a whole seminar and framework scenarios that companies can go through and how to address COVID as a challenge. And it's very detailed on cash flow management, team, working from home, a lot of things, finance, many things, and different scenarios. It's a very big tool that companies can use to be able to make decisions, and framework they can use to navigate that. So we've done a lot of that as well to help our business. But at the end of the day, a lot of business just need cash, and then we are here to support that and catalyze that for them. But the last bit that I'll say is for the businesses that we think this is a perfect storm for them to actually grow, because it creates opportunity for them. We are making sure that we're catalyzing their round. We're putting money on the table. We're getting other investors in. We're creating that confidence that investors need for them to actually grow at this stage. So M-Pharma, for example, they are doing COVID testing services in Ghana and some other places. They are strengthening the value chain, the healthcare value chain that is needed mostly at this time. And so that's a kind of support we're providing. But last bit before I pause is we are partners with our entrepreneurs. We're not just investors. We're partners with them. We're in it with them. So what we do, we are available to have a chat with them. We are not just available. We actually engage with them actively, sounding board of ideas, pivot or whatever, and sometimes as agony hands. So to talk to you about psychological, mental health issues that founders we go through with so much decision they have to make. I say this having been a founder, that is a very, very challenging time. No matter what your capital is as a company, it's very challenging time as a founder at this stage, especially if you're hit hard by COVID and knowing that your business is doing well, but just COVID is just affecting it. It's a very hard time. So we are always there to actually be the mentor, health supports, therapists for our founders.
Well, thank you for your answer. I think you mentioned the key parts of the challenges that entrepreneurs would have around funding, strategic support, and just being there, like you said. This next question is two-pronged because I think the questions are related. And it's just saying, a lot of people are saying it's going to be more difficult to raise money, especially as an African founder going forward. What are your thoughts on this, and what is top of mind for you as a VC? What are you looking for? I think I'm also going to add to that and say, what are the top risks and mistakes that investors observe in African startups? And how should people who are listening today, what should they do differently?
Yeah, thank you. There's lots of questions there. I'll do it to remember them. If I don't, please stop me. And
sure, definitely.
So the first one, remind me again, is about
post-COVID. What do you see investment?
How hard is it for African founders to raise money post or during COVID?
During COVID, post-COVID, as we go on.
Yeah, to be honest, and I'm sure a lot of founders are here. I can see some names, founders there. It is actually difficult before COVID, more difficult for African founders to raise money compared to their European or American colleagues. We same similar type of business, similar type of traction, similar type of background. It's more difficult for African founders to raise money, and for various reasons that is beyond the founder's control. And one of it is the funding ecosystem in Africa is very small, and it is still very new. Before 2014, before Novastar raised the first fund, actually there were maybe none or maybe very few or low number of VC, as in venture capital in Africa before 2014. There were lots of PEs who maybe write some checks for entrepreneurs. Before 2014, if you are building a high growth business, similar to the ones that we're seeing now, like Paystack, Flutterwave, and some of those guys like that, you have to go outside the continent a lot for you to raise beyond Series A. You can maybe do seed in Africa, but beyond Series A, B, C, you have, even now you have to do that, but you have to depend a lot on VCs outside the continent because there's no VC infrastructure. Then you have PE, but there's no VC. And PEs we're asking for 3 years of EBITDA, positive EBITDA before they can invest. And startups don't have positive EBITDA 3 years. So the top, yeah, even just me 1 year. So it's challenging for that. And the second challenge is also the economics, the macroeconomic in Africa. Yeah, there's lots of opportunities and potentials in Africa. A billion market, huge full mobile phone penetration, education, rising middle class. Some other things that we could talk about, like you see in a lot of charts and graphs that people present in London and New York over latte and coffee. Those are true, but if you look at the fundamentals of it, how many of those people with smartphone actually buy from using their smartphone? How many of those youth population are employed and have spending power? How many actually are online and will actually get all their value chain online? So many things. If you go deeper into many layers, you realize that the market is thinner than it is in the front end. So that makes Africa a little bit less for someone who is just looking for dollar returns. I can put my money somewhere else in America with less risk, and I'm sure I'll get my money back in less than 10 years, because the ecosystem, the investment ecosystem is more mature. There are more people that can buy my shares down the line and IPO and other stuff. But in Africa, the market is smaller than I'm seeing. Yes, the opportunity is huge. Market is smaller, it's risky. And so founders find it difficult. The third one is, at the end of the day, money is relational. And what I mean by that is people invest in people. Yeah, we can look at opportunities and other things and great business. But at the end of the day, people that write this check, even institutions as well, you look at people, and maybe that will touch into some of the other questions that you're asking. You look at, do I believe this founder or this team can execute against this opportunity in a good way that will return my capital for me? Do I believe that? And a lot of things you have to believe for you to get to that place. So one is their background, is the education, is what they've done before, the traction, how they appeal to you, what they say, how do you judge them? And a lot of it can be objective, but a lot of it is subjective. It's about, can I relate with this person? And one way I can relate, okay, this guy went to Harvard. Yeah, he must be smart. Or this guy knows somebody that I know that is smart. Therefore, if that person rates him, then he's smart as well. Oh, this guy has built a business that I understand. Okay. And a lot of that is subtle, but it works against a lot of African founders, because the people that write the checks are not Africans. A lot of people that write the checks are not African. So it's just recently they were changing that narrative with VCs like us, like Alethea, now raising a fund, that raised their fund, like Tiacom, Patek, who are focused on Africa. They're not just VC in the Valley or London who say, yeah, maybe I'll take a gamble on you. The people who raise fund and our focus is Africa. So it's getting easier, but it's still difficult. So now going back to COVID, I don't know how COVID has changed that too much. Some of the things I talked about are still there. But COVID maybe made it more difficult in terms of there are less people now writing checks. Apart from us, that like I mentioned us, Patek, Telecom, we've raised money. And between this people I mentioned, we have like maybe 300 or almost $400 million to invest in Africa. We have that now. And we're looking for business in Africa to invest in as a VC. Apart from those people and African investors as well, who just really close their fund, and many other people that are about to announce that they've closed their fund. Apart from that, there are less capital now in terms of people that are just looking opportunistically into Africa, because COVID has wiped out a lot of their gains from public investments, and a lot of people are now cautious. So that has reduced that. And there are also a lot of angels who are thinking, I have $200,000 to invest in startup before now, but now all my shares in public, something has gone down. My income has reduced, so I'll just keep that money in my bank account. I don't know how this COVID thing will. So that's reduced the amount of capital from those places. But deals are still being done. People are still raising money. Now, the pricing may be different, the valuation might be a little bit different, and the amount of capital they're raising might be lower than before. But if you have a good business, you're addressing a large market, and you have a very good team, and you have a venture style business that could return good income, returns for good investors, you still be able to raise money at this stage. Now, the only caveat I would put to that is your game has to be higher and top notch than before. You must have very, very good answer to COVID, not just immediate COVID answer, but how will your business fit into post-COVID world? You must have answer for that. You must also have answer for how would you be able to cope if COVID thing extend for a long time in terms of cash flow and manage and extend your runway. You must have answer for all of that. But fundamentally, if your business is good and you're addressing a large market and you have a good team and there's huge upside, you will raise money as an African startup founder.
Thank you. And so the second part was, so your business is good. You have a good business that can bring money for investors, and you have a plan for COVID and post-COVID. What are the risks that you see people make, mistakes that they make, that you as a VC would look out for, and you think that, what do you think people can do to mitigate making those risks or presenting themselves in the wrong light?
Yeah, that's a good question. So I'll make it maybe specific to African founders. We could spend a whole webinar on mistakes that founders make when they're raising money from VCs that they have to watch out for. There are fundamentals on our business model fit into the market, understanding of the unit economics, all those things that are generic that we could talk about. But I want to focus a lot now on specific stuff for African founders. One is you need to understand that not all businesses, and including yours, might not necessarily need venture capital investment. And that doesn't make your business less important compared to the ones that raise venture capital. There are lots of successful businesses in Nigeria that have been built without venture capital investment. And you need to understand that. So, and that will help you to be able to know how you align your vision and your interests and your expectation with that of the investors. And that ties into the second thing, which is you need to understand the investors, where they fit in the funding ecosystem. Like, for example, I'll talk about our thesis. If your startup or your business is, if the success of your business is not intrinsically linked to solving problems for the low income mass market, then Novastar is not a good deal for you. That doesn't make your business bad or Novastar bad. It's just that we're not a fit, because our thesis is basically we invest in startups that are the growth is linked to the low income mass market. And you can say, oh yeah, but my business will hire people from the low income mass market. That's not what we're talking about. Is that can this business succeed? And only by serving the low income mass market. For example, you can have a bank. A bank can succeed without solving problem for the low income mass market, but just solving problem for middle class or for businesses. So you have to understand the thesis of the investor. The second thing about the investor the mistake a lot of founders have made is to not understand where does the investor fit into their growth. So if you're like you're still very early stage, you have not done your product, you've not your pre-revenue, you've not said a lot of things. There's no point you talking to VC in Africa. Now you can talk to VC in Europe at that point, because some VC in Europe can still capitalize that because a lot of seed, very, very early stage seed. Because VC in Africa, because we are very few of us, and the bar can be a little bit higher. So even though we are early stage, and we are early stage, we don't turn people down because they're super early. It's just that you have to have some proof point, right? And that proof point is important because we are comparing you with every other opportunities that we are seeing, not just people that you're competing against head to head, but every opportunity that we're seeing. So you have to have that proof point, and that proof point you might need maybe early stage, more seed stage investors like friends and family or accelerator or program to help you get there. So understand that about African investor helps you a lot. That's okay. You don't go there. You don't engage with them until you understand where they see. The third one is basically African founders, and I've found it challenging, especially people that maybe have not studied outside the continent to some extent, or people that have not grown beyond where they live, where they grow up, live beyond where they grow up, and not just outside the continent, but outside maybe the state. is being able to see the big picture. The big picture is, can you tell the story that an investor can buy into to say, yes, I can see how this business will scale and either win or change or radically change the industry that they're going into, rather than just making money. So there's a lot of them. Yeah, we're gonna this is our business plan, our growth plan. Year one, we're gonna do $10 million. Year three, we're gonna do $50 million, and we're gonna return investment for you. What we know about your business plan, and for every other business that we've seen, is that it is wrong. Your business plan, we want to see it, but we know your financial. The only thing we know is that it's going to be wrong. It's that you over project or under project. So that's not it. It's the thinking behind it. How do you see scale, and how do you create that big story? Like you, and a lot of Silicon Valley founders do well about this. Our business exists to change the way people drink water out of a mug. That's the fundamental problem that people have, is they don't know how to drink water out of the mug, and it's a big problem. They're spending a lot of money on it. And we're here to solve that problem, to make people know how to drink water out of this. They know how to create that big story that everybody wants to jump into. And African founders need to know how to do that well, but also do that in a way that is not ingenious, that is not lying. So there's a big difference between overselling and telling a narrative and a vision. You don't want to oversell. And I see that a lot with a lot of Nigerian founders, I must say, having been in an investment firm that we invest across the continent, a lot of Nigerian founders tend to oversell. and oversell means you say something. A good example is, you have 15,000 people in your email list, but you go to investors and say, hey, we have 15,000 users on our platform. Now, yeah, you have their email list, but they're not users. Right? That is overselling. And then when we did that, we said, actually, guy, you only have their email list. You have their email. They're not using your product. They've not signed up to use your product. Oh, yeah, but they can convert them. No, that's different. So and when we find out that, and a key thing that underlies every investment, whether here or anywhere in the world, is trust. Because we have to trust the number you're giving us. Because we're not going to be going to your bank account to see whether you are making the revenue you said you're making. We're not going to be going there except we have an issue to disbelieve what you're saying. So trust is fundamental. So do not oversell, do not lie. The last bit before I pause is the kind of team that you have with you, and the mistake that our founders make that I see is the team that they have with them. And that comes out of sometimes insecurity of some founders to say, not to be generous enough to give equity to people that are equal to them or even better than them. The most important role that you play as a founder and probably as a CEO of a startup is to hire the best people around you to execute your vision. And in some cases, those people might or should be smarter than you in many areas. Actually, you shouldn't be the smartest guy in the room. You should have lots of smart people, and they're better than you or more experienced than you. And ability to attract those people is very key. And not only that, ability to get those people and be able to either sell the story to them or compensate them well. When I started my business in the UK, then the first major guy that I hired, and I've hired a lot of people, the first major that I hired to the top level was earning more than me. And that's the only way I could get him in. I said, okay, it's my salary, okay, we'll find out. And he was earning more than me as a founder, and I was a CEO. And because I put value into that. And be able to do that, and not just the salary, but also compensation in terms of shares. It's very important. Those are some of the mistakes that we see founders make. And the last bit is how you raise money. Don't give too much at the beginning, especially if you're doing a business that will need capital over a long period. Don't do a deal at 50% of your shares to an angel investor. That just kills your ability to raise money down the line. So I'll post it.
Thank you so much for that, Dotun. We've been getting some questions in the Q&A, and I'll just ask them in batches because some of them are quite similar. One of them was how to approach a VC. You've mentioned some things on what not to do, but if you got an email from someone who says, oh, I want to raise funding for this business, what will make you reply that email What are you looking out to see? How can they even start that initial conversation?
Yeah, this is a very interesting one because most VCs, we like us as well, we are very relational. So I try to reply most emails, but I wouldn't promise that I reply all the emails because we get a lot. But I try to reply most, depending on how it is. But the waiting for it is this. If it's some, if the best way to get a VC, and I think it should change in order to democratize access, is through relationship, right? If you know someone that knows them, that way, because this is still a lot. We see maybe 1,000 deals a year thereabout, and we only invest in maybe three or four. So you can see, and a lot of it go to different stages, right? So if somebody that we know that we trust or that will know us and introduce, that's fine. We can then have a look. But then but the key thing is to get if you've done your homework, it's okay. This fits into their pieces. The amount of money I'm raising fit into what they do. The stage I'm in fit into what they can look into, and then you send an email. Even if I don't know you, I see that email, and it's not long. It's not, and then you're not sending it through LinkedIn. Generally, I ignore most stuff from LinkedIn, to be honest, because it's just too much. So there's a lot of unopened stuff on my LinkedIn. So you want to get through. If you have my email or people, or you know people that knows and introduce, and I'll look at that and say, this is. If there's a deck, it helps because I can see the deck. And I'm talking for myself here because some VCs they have a form that you fill. We don't have a form that you have to fill, and that form too helps a lot because it sees a lot of things. So I look at it. Okay, if it fits in, I could either make a decision to say one. I will ask you to have a meeting with me or one of my colleagues, and then we jump in a 1 hour chat to know more about the business, and then we can take it further if necessary. Or I forward it to someone else who would then look at it and say, this fits in and this no, and then they'll send an email to say, sorry, it doesn't, or it fits in. But the key thing there is you have to be compelling in what you say at the beginning of that email, and maybe and also the deck. But you have to have done the homework. So there's no point somebody pitching me and say, hey, I have a bakery business that you should invest in. Just no matter how good you write it, I'm just going to ignore it because it doesn't fit into what we do. It's not scalable. It's not that kind of stuff. It's not. It doesn't fit in. And I would just say I can reply if I think if it's a low day, I can say sorry, this doesn't fit into our business. And I try to be nice to people when I say no because having been a founder, I've received a lot of no's, and the way those no's come can be hard. So I try as much as possible to be nice to people when I do reply. But if I do meet you and we have a chat, and my rule is that if I meet you and we're saying no, I don't do it by email. I will call you or arrange a call to say this is the reason why we cannot invest in your business. I wish you the best of luck going forward.
Okay, thank you. I'm sure because a lot of questions about that, and now they know better than to come on your LinkedIn and send you a message. Um, Another question I had, and we talked about this a bit before we started, and you also mentioned the dollar for dollar investments. So in this, in the situation where we are in, where the dollar, you're making money in naira and you're paying your investors in dollars, how do you think investors can navigate this, and what are you doing as a VC to support a bit this situation?
Yeah, I answer the second question. Second question: there's nothing VC can do to support the naira devaluation. It's a macroeconomic problem. Maybe longer term, we can all build businesses that will be good for the ecosystem, that will make naira better. So there's nothing we can do about that. But what's our view on it, and how do we view companies that we're investing in? We invest $1 into them, but they're earning in naira, and suddenly last year, let's say their revenue was $10 million because they converted the naira they are making into dollars for $10 million. But this year it's now $7 million because naira has reduced in value. What's our view on that? This is something where we thought a lot about, even whilst we're raising a fund and in Africa, and I'm sure every VCs and LPs that invest in Africa have talked about this. And my views here might be simplistic, but this is what I claimed. One is As a venture capital, you are investing in future value, in a discounted value of the future rather than present ones, which is fundamentally different from private equity, other private. Look, this is an asset class. It's part of the asset class, but it's different from other part of that the asset class, which could be looking at discounted cash flow now and use that for valuation. So when we value a business, or when I'm talking to a founder, I'm valuing your business. I'm not valuing it based on what you're what you've done now or what you've done. Okay, what you've done gives me an indication of your ability to execute. Your traction gives me some indication. I can put that into the valuation. It contributes, but that's not the major reason why I'm investing in your business. And I'm valuing it. That's why similar businesses with similar traction might be valued differently because there's so many factors that go into it. Is I'm paying a discounted price for the future, which is basically I'm saying I believe that this business will grow to X amount in 5, 6 years time. And the value of the business, not just, and which will be a contribute, which is a factor of their revenue, is a factor of the market, is a factor of their opportunity to create value, is a factor of their growth. Uh, the value in 6 years' time will be far more than what I'm paying now. Therefore, I'm paying this one as in order for me to be able to get that value in the future. So the naira dollar thing does not really, it is a factor, but it's not a strong factor. Because as long as the business is growing and the market is huge, and also the business can also grow across multiple geographies, fluctuation in the currency that they are earning now, it's not irrelevant, but it's not as big. The only way it becomes a big factor is if they're only focused in Nigeria, or the biggest market will be in Nigeria, and the valuation of the future will be hinged only on the revenue that they make. Of course, revenue is a factor as it grows, but it's only hinged on the revenue that they make, and then it becomes all the price that I'm doing now. I've done it discounted. I've done multiple. So how much did you make last year? $5 million. Okay, I think if I put 3x, you are now $50 million. Okay, agreed? Yes. If my valuation is based on that, then naira valuation devaluation will be a fact, will be a problem, because in the future we can say, okay, maybe in the future there will be 50 million and then we times it by 3. But that's not how you value startups. So you look at that value that you create and the discounted future. So having said all of that, the valuation of the naira is still a very big problem because it impacts your traction story. And it creates risk as well for people that are looking into that market. But what I would say is that as a founder, you don't worry too much on that. Again, it impacts you just have to manage your forex very well. So you keep as much money in your foreign in dollars. So if you raise money in dollars, keep as much of it in dollars, because the inverse is also true in the sense that now maybe you negotiated a lot of your costs in naira. For example, salary in naira, or rent in naira, or a lot of things in naira, right? Last year you spent $100,000 per month. Now it could be $70,000 per month that you're spending. You get what I mean? So, but as much as you are edging your risk with that works, but you're also growing. So I think what we are betting on is the growth rate of the business. As long as your growth rate is faster and better than not just the devaluation of the naira, but also the economy, the way the downside of the economy. If your growth rate is better than that, then you're fine. And then we will continue to invest in you as a business. So that's the only way. That's my simplistic response to a startup. Lastly, I'll say recession is a big one. I think Nigeria will be facing recession, and most part of the world will be facing recession, not just for COVID, but because of what COVID has slowed a lot of things down. So post-COVID, there will be a recession, and that will affect everyone generally. So as a founder, you have to think about that, and there are many ways, many approaches. You either raise a lot of money, you reduce your cost, or you go hard on you kill things that are not essential, and you go hard on the most important part of your business.
Okay, thank you for that answer. We're getting a couple more questions, but I am also conscious of the fact that we have about 6 minutes more. We'll leave the attendees with your contact so that they can, I know you're very active on Twitter, and they can reach out to you with their questions directly. The last thing I want to say is, what are your final thoughts to everyone attending? It could be, what are the myths about VC that you want to bust? What are the key things that they should hold? Top 3 things, anything that you think you should leave us with?
Yeah, that's good. I think I'll go with that myth about VC that people should bust. I'm assuming most people here are founders or people that want to invest in, or that want to do businesses. The VC is not smarter than you. Actually, VC is less smart compared to you in your business. You should, when you enter into a meeting with a VC, you should go with a mindset, not with an attitude, but with a mindset that I know, and you should be able to back it up. Like, you should know a lot about your business, the industry, the market, the competition, and the VC. And you should be able to demonstrate that. And that comes from, so when I was an academic and I was doing a PhD, I have 4 supervisors who are, 2 of them are professors, 2 are doctorate, and they're my supervisors. So every time we have a supervisory meeting about my PhD, they ask me questions, progress, blah, blah, and I have to defend a lot of my papers and stuff. And one of my supervisors told me, whenever you're coming to this meeting, Doctor, you should know that you know more than all of us in the room. You are the experts on this field, and you should be the most. You are the expert on this particular topic above anyone else in the world. So you should come to the meeting with that mindset, and you must be able to demonstrate that. So that's something I talk about founders. If you go to a meeting with a VC, the VC don't know more than you. And so you should be able to approach that meeting with that with partnership, and you should also not just the VC checking you out, but you should also check the VC out. Can I work with this person for the next 10 years? Can I work with this firm for the next 10 years? It's more of a partnership than you begging for money. I know it could feel like, okay, these guys have got $100 million that they want to invest, they will make a difference in my survival. But VCs respect founders that see them as equal partners and create value. Because at the end of the day, VC is a business. Our business is to invest in startups, and our customers are startups. So we are always pitching and begging and looking for customers to invest in. And when we meet you, we're looking, would this be a customer? Would this be a customer? Would it? And so you have that mindset. Therefore, your approach to constructing your business model, getting in your market should be very strong and good, so that you can go into a meeting with a VC with that mindset.
Thank you so much. We have about 3 minutes. I'm just going to throw one last one in. People were asking about solo founders. What do you think about solo founders? Do you think there's an advantage or disadvantage? Because you were talking about team earlier.
Yeah. So in Novastar, we are very averse to solo founders. We've seen journeys of founders who have struggled because they don't. It's a very hard work to be an entrepreneur, and so having been the only person that take all the shoulders of the risk is very hard. So we always encourage founding team. Now that doesn't mean you have to always found with somebody. It could mean that you may have started it and you get other people, but the plurality of leadership is very important. That means you have people that complement you and are equal to you. They might not have to be exactly equal in shareholding, but they are equal in their view, in their risk, in their compensation, and in the opinion that they hold in the business as you. And that plurality of leadership is very important and it's key. Now, so we have businesses in our portfolio that have one founder, but they have that leadership ring around them. Having said that, data shows that single founders do better than team of founders over time, right? But that's the law of outliers, right? But we know that those single founders, they have with them ring of founders, because one of the biggest we can find in startup is leadership, is founders fallout. Having said that, lastly, you have to know that there are very few percentage of founders in the world that have taken their business from early stage to the end, to the top peak, I exit, IPO, and steady state. Very few. We're talking about people like Mark Zuckerberg, Jeff Bezos. Founders are for different stages, and it's leadership team of companies change. Even Mark Zuckerberg have to change a lot of leadership. They call the leadership change because skill sets for building a business in Series A or a steady state or multi countries, 500 people is different from the skill set necessary to start it. You must always know that and understand that, and see that there might be a point where you have professional handlers that will come in and populate the leadership. So that's our view about startup founders. And it's about, for us, we're more averse to having multiple leaders in the startup.
Thank you. Thank you so much for your time, Dotun. I have shared your Twitter handle and you'll be getting some more questions. Thank you everyone for attending and for making the time. Have a wonderful rest of your Friday.
Thank you, Nika and Precious.
Thank you, Dotun, and thank you for everyone for attending. I just wanted to say this video will be up on YouTube, so you can catch up there. You can share with any upcoming founders, but have a good afternoon, everyone.
Yeah, bye.
Bye.